Hi, this is Jeffrey Kerr at Kerr Financial Group, and today is October 18th, 2023. And I'm going to begin with a quote that's attributed to Vladimir Lenin that goes, there are decades that go by when nothing happens, and there are weeks that go by when decades happen. And I believe 2023 has had multiple decades, in within the year. Just so much bad news, and what all the things that are going on. But one of the questions that I try to tackle and answer for clients is that why is it that we have all this bad news and yet the markets hold together and seem to be stable. I think there's the appearance is a lot different from what's going on. But let me also then move to the concerning the markets, what the year-to-date returns are as of last night. So the Dow is up 2.5%. The S&P is up 13.9%. The Nasdaq's leading the way up 29.3%, and the Russell 2000 is flat for the year. So the point, one of the things I think that needs to be, understood here is that the leadership of the stock market in 2023 is very narrow. Recently it's been called the Magnificent Seven, and I've talked about it before in previous videos and newsletters about the S&P 7 versus the S&P 493. So the seven are Amazon, Apple, Alphabet or Google, Meta or Facebook, Microsoft, Nvidia, and Tesla. And those stocks are up, combined 57% for those 57% in 2023. So if the S&P 500, well, the S&P 493 are only up about 4% for the year, again, versus the 14% with the seven. And so the point is that these seven stocks have held the markets, the stock market especially, together. I mean, the bond market's been a bloodbath this year. Interest rates keep moving up, and that's going to bleed into the economy as well in terms of higher interest rates are going to be higher cost of capital. There's a lot of corporate debt that needs to be rolled over in the next 18 months to 2 years, and that debt cost is going to go from below 5 to well above 5, and maybe even double digits for some companies that need to, and that's going to be a huge cost increase. Also, those higher interest rates are impacting mortgages, credit cards, auto loans, and like that. So there's a far-reaching impact that I think is a strong headwind to the economy. And I think that the narrowness of the leadership of the stock market is giving a lot of false hope and to a lot of investors and traders. But I think also I read about that as long as the seven are going up, that's what they're going to buy. And that as I wrote in a recent newsletter about the systematic or automatic investing, as it goes into an Apple gets bigger, which then means it gets more money because it's bigger, and it's kind of a big circle that's really that's working a little bit. But if the flows reverse, it could be a very unpleasant environment. I think another interesting statistic is on the S&P 500, so the S&P 493. That PE is around 19 times, which is historically in line with most of the history of the S&P. The 7 during 2023, that PE has moved from 29, which is expensive to start with, up to 45. And the conclusion here is that either earnings have to start moving up higher and dramatically higher quickly, or the stock market prices have to come down to a more reasonable level versus as compared to those earnings. So I think that who knows that this magnificent seven could continue to drive the market, but at some point I believe that it will be a day of reckoning. As we get into the fourth quarter, there's a lot of underperformance by professional investors, and so there might be the rally into the year end and fourth quarter just to prop things up and to help them look for performance. But again, there are a lot of negatives out there that could curtail the market at any time. Thank you for listening. Please feel free to send any questions, comments, suggestions to me, email, call, or text message. Thank you. Goodbye.